Good afternoon. My name is Patrick, and today I'll be joined by Rishabh on the affirmative team. Corben and Damien are on the opposing side. Rishabh and I strongly believe that active investment in levered residential property by SMSFs outperforms passive investments in unlevered equities. This strategy, when executed responsibly and within ATO guidelines, allows trustees to transform disciplined leverage and property selection into stronger long-term retirement outcomes. Today, there are more than 650,000 SMSFs, 1.2 million members of SMSFs, holding over $1 trillion in assets. Around 24% of that is invested in property, a figure that is steadily rising every year since LRBAs were introduced in 2010. Why does this matter? Because SMSF trustees are choosing tangible assets they can control over passive exposure to equities. They're using regulated borrowing structures to increase returns inside a conservative framework. As James O'Reilly stated in our lecture, the fundamentals that drive the Australian property market are very different from equities. Unlike equities, property isn't priced every second. It reflects long-term fundamental values. CoreLogic and ASX data shows that over the past 20 years, housing has consistently outperformed Australian shares. We don't want to just tell you why property is better, but we'll show you. We created an active SMSF property versus passive equities model, a 15-year side-by-side comparison of two realistic strategies. Here are some key assumptions from our property model. A starting super balance of $408,000, a $1 million property purchased at 80% LVR with a $200,000 deposit, a 7% gross annual capital growth. Using a 7% gross is a fair assumption considering active trustees don't just buy a median house. They target growth locations and high yielding stock. 4% rental yield, 7.79% interest rate, a liquidity buffer of $150,000 with 90% of that being invested in a high growth super. Both portfolios are taxed under SMSF rules. Our equity models has identical $408,000 upfront investment in unlevered diversified high growth equity fund, returning 8.1% per annum. The result? After 15 years, the levered property SMSF finishes at $2.25 million versus $2.05 million for equities, an outperformance of $200,000 or 9.71%. These are conservative, evidence-based inputs. After 40 years, property is ahead by $4.5 million or 26%, which shows the power of compounding returns. This waterfall graph shows where the outperformance comes from at year 15. Property value, which is a mixture of capital growth, compounding returns, and leverage. These results are not inflated by assumptions. They're backed by ATO policy, CoreLogic data, and independent market research. I've established the foundation of our case, a clear, conservative, and fully compliant model showing that property within an SMSF generates stronger long-term wealth outcomes than unlevered equities. Thank you. And now I'll hand you over to Damien from the opposition.
Thank you, Patrick. You raised some great points. However, I'm compelled to dispute your projected growth for property SMSF, upon which you've argued why it's a superior option. Patrick mentioned that property enjoyed strong growth for over the past 20 years, and on this basis, 7.7% gross annual capital growth was a reasonable projection. However, this is a clear case of survivorship bias for residential property. As an asset class for super in Australia, its demographics and underlying factors has changed immensely in the last 20 years, and he has not produced evidence that the underlying factors which drove this growth will be the same in the future. Moving on, I'll now present the first argument as to why passive unlevered equity super funds are a superior option. The lack of diversification across asset classes inherent with leveraged property, SMSFs, will amplify exposure to market downturns. This is supported by data from the latest ATO annual SMSF overview. The data revealed that as of June 2023, of the $59.8 billion worth of assets held under LRBAs, 97% of LRBA assets were real property, with 42% held in non-residential and 55% held in residential properties. And crucially, 86% of SMSFs reporting an LRBA held just one property. 8.8% held two properties, 1.8% held three or more, and 3.6% held no property. Thus, given most of these SMSFs held just one property, demonstrates the concentration risk inherent with this strategy. Such an SMSF will be directly exposed to any value increases outperformed by the equity index or market downturns with no source of diversification to offset this risk. However, this is a risk which a passive equity super is inherently designed to manage. While equity itself is a single asset class, its value depends and differs on factors such as performance of the underlying company, its assets, industry sector trends, and public image. Thus, equity return between different equities when compared with one another within the index is less correlated. This is reflected in Exhibit 1 in the data of ASX 200 equity value changes in the past 1 year to date when categorized based on the 11 industry sectors. For example, while healthcare industry shares fell by 14.8%, these losses were offset by the financial service industry gains of 19.03% in the same period. This demonstrates the inherent risk mitigation benefits enjoyed by passive equity index supers, which property SMSFs cannot benefit from. Consequently, Exhibit 2 shows that year to date, the ASX 200 index has grown by 9.42%. Moving on, the graph in Exhibit 3 depicts that 3 years to date, the ASX 200 has experienced an annualized growth rate of approximately 9.78%. Meanwhile, Exhibit 4 depicts the growth of total value of dwellings from June 2022 to June 2025 as released by the ABS. The graph and data shows within roughly the same period as Exhibit 3, total dwelling value grew from approximately $10 to $11 trillion, which roughly equates to an annualized average return of 4.86%, well below the equity performance of 9.78% per annum. The total value of dwellings will include dwellings which perform below the 4.86% average, as well as below equities, and if an SMSF were to be solely invested in one of these properties during this period, this will negatively expose a super compared to an equity super. This does not include the tax and expense advantage equities enjoys, which Corben will explore in more detail. I'll now hand over to Rishabh.
Thank you, Damien. On concentration, you cite ATO data showing 86% of LRBAs holding one property, but concentration risk isn't about asset count. CoreLogic data shows residential property has lower volatility than the ASX 200 over 10-year periods. We're concentrated in a less volatile asset class with structural supply constraints. That's disciplined allocation, not reckless concentration. On your 3-year comparison, the consecutive rate hikes you showed were cherry-picked. That was deliberate policy cooling. CoreLogic shows 8% property growth in 2023 once rates stabilized. We evaluate retirement assets over 25-year horizons, not monetary policy cycles. Over 25 years, CoreLogic confirms 6.8% annualized growth. Your 4.86% dwelling growth ignores leverage. With 80% LVR, there would be a much higher result on the deposit. You compare unlevered property returns to levered equity exposure through super. That's comparing apples to leveraged oranges. Diversification without returns is just inefficiency. Now let me show you why structure drives outperformance. Thank you, Patrick, for showing the numbers. Now, here's why those numbers aren't just luck. Leverage. Under ATO approved LRBA, an SMSF can control a $1 million property with a $200,000 equity and 80% LVR. Compounding occurs on the $4 million, not just the deposit. CoreLogic's Hedonic Index shows a capital city dwellings average 6.8% growth over 25 years. Sydney, 7.9% itself. So a 7% assumption in the model is conservative. Even paying 7.79% interest rate, the math is clear. 7% growth on $1 million outpaces 8.1% on $200,000 worth of equities or shares every year. That's arithmetic under ATO regulated leverage. Coming on to the tax architecture. The SMSF tax system creates a lasting advantage. Rental income is taxed at 15% in accumulation and 0% in pension phase. Property investors deduct interest, maintenance, depreciation, and land tax. PropTrack 2025 reports 4.47% rental yields, above the ASX's 3.65% dividend yield. Even after 30% expenses, our model stays positive and still finishes $199,000, 171 ahead. Equities can't deduct borrowing costs or claim depreciation. SMSF law rewards long-term income-producing assets. Coming on to the supply crisis now. This isn't a cycle, it's a structural shortage. ABS data reveals that approvals are down 6% in August 2025, while migration added 518,000 people in 2023 to 2024. ANZ CoreLogic forecasts a 106,000 dwelling shortfall each year to 2027. Master Builders Australia reports Sydney construction costs up $240,000 since 2018, a cost for limiting supply. With infrastructure and zoning delays, the imbalance will only persist. Active SMSF trustees focus on Western Sydney and Southeast Queensland, where demand exceeds supply. Coming on to the inflation hedge and investor discipline. Property is Australia's most reliable inflation hedge. CoreLogic shows dwelling values rose 8% in 2023, beating inflation and OECD peers. The RBA calls housing the strongest long-term wealth protector. When the ASX fell 12% in 2022, property recovered within 10 months. That's behavioral discipline. Investors hold, repay, and build equity. We agree with the caution that a success needs conservative assumptions and disciplined leverage. Now, addressing common claims. Liquidity. Super is long-term. Liquidity is irrelevant before preservation age. Risk. Our conservative model still wins. Diversification. Property diversifies through structure and cash flow. Now, coming on to the conclusion. Leverage amplifies growth. The tax deductibility creates structural advantage. Real assets hedge inflation and enforce discipline. The result, after 15 years, $199,000, $171 more wealth. After 40 years, $4.5 million more, a 26% outperformance. This shows active leverage property in SMSFs doesn't help to outperform. It's designed to. Thank you. Now passing over to Corben for the negative side.
Thank you, Rishabh. You raised some interesting points. One that stood out to me was your claim that SMSF property with an LRBA beats equities due to leverage. However, I think it's important to note that leverage can be a double-edged sword. While it boosts gains in rising markets, it also magnifies losses during downturns. Also, the high loan-to-value ratio increases this risk further, and rising interest rates could crush cash flow, especially if rental yields are low or vacancy rates rise. Equities, on the other hand, with lower costs and no borrowing constraints, offer similar long-term growth with less risk and greater flexibility. Also, properties tax benefits don't guarantee outperformance if you don't have taxable income to offset, especially if markets stagnate. Now, continuing on, levered property in SMSFs may promise growth, but these assets also incur crippling financial management costs, which could slash net returns and make passive equities a far superior long-term wealth creation. I'll start with the staggering financial burden of this retirement plan. Damien noted that 86% of LRBA hold just one property, and RBA states that this was the highest at 7.5% between an asset range of 500K and 1 million. So let's take a residential property valued at 750K with a 5% stamp duty as a rounded average for all different states. This would equate to 37,500 as a sunk cost for the investor. An SMSF loan of this value with a minimum 30% deposit and a generous 6.24% PA fixed interest rate compared to the RBA's recommended SMSF safe harbor rate at 8.95%. This leads to a $4,600 monthly payment or 55.5 yearly payment, according to loans.com. Figure 1 from ABS data has the median expenses for SMSFs between the asset value of 500 and 1 million. This totals to nearly 72 grand a year of expenses that can be seen by figure 2, which would require a weekly rent of 1,500 to break even. In this case, since the SMSF's only source of income is rental yield, the shortfall must be covered out of pocket by SMSF members. Now, in contrast, passive unlevered equities like ASX 200 incur minimal costs. For instance, UniSuper has a 0.51% management fee and fixed $96 administration fee, assuming the equities can invest the same amount as SMSF's property deposit. This would be annual management fee of only $1,244, which would be offset by the addition of franking credit rebates, which averaged 1% in August, according to the ATO from S&P Dow Jones data. So in conclusion, levered property in an SMS may receive a gross return when selling the asset for retirement at Damon's previously mentioned 4.86%. However, a clear financial burden from managing and financing the property year to year would require significant member contributions to the fund, which would lower net returns in the long term. Considering this, unlevered equities passively invested are a superior long-term investment. Thank you. I will now pass you on to Patrick.
Thank you, Corben. The opposition's arguments collapse when tested against real numbers. Yes, property has higher year-to-year cost due to leverage, but that's because growth compounds on the entire property value, not just the deposit. They claim you need $1,500 weekly rent to break even. This misses the point entirely. Cash flow break even is not wealth outcome. Property builds equity through capital growth, even with negative gearing. Our 15-year model includes every cost they mentioned and more: stamp duty, land tax, maintenance, LRBA charges, using a 1.55% higher interest rate of 7.79% compared to their 6.24%. Even under stricter assumptions, property still outperformed equities by 9.7% over 15 years, proving leveraged property compounds faster and generates greater SMSF wealth. In short, if we ran their numbers, property would have won by a much greater margin.